Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, welcome to Pilot Money Guys, Flight 123. Again, I'm your host, Charlie Mattingly, here again with Chief Investment Officer at Leading Edge Financial Planning, Andy Christopher. Andy, welcome today. How you doing?
Doing great. Happy to be here.
Yeah, man, we got a lot of exciting stuff.
Yeah.
I've had about 5 cups of coffee. It's about 18 degrees outside, and I'm fired up, ready to go.
I'm 1 3/4 cup in. It's
excellent.
Maybe 60 degrees outside.
Okay, nice. Thanks a lot. I think we got a big snowstorm heading our way across the country. I think Texas is going to hit it, Southeast is going to get it, and then good old East Tennessee maybe. We're looking for sleds at Walmart, but they're sold out.
There you go. If it makes you feel any better, I'll be in Ohio this weekend where it's like -4. So I've got mine coming.
You deserve that.
Yeah, absolutely.
Awesome. Well, we're going to jump right in. Today, we have a ton of stuff to cover, and we might even have to break this up into 2 parts. So we'll be ready for that. But just to give a high-level overview, we're going to address the most recent changes in the airline 401ks about the Roth catch-up contribution. We'll talk to some nuts and bolts on that. We're going to also touch on this option where you can make your NEC Roth as well. Who might that be good for? How do we think about that? And so then you brought up a couple things, questions from the flight deck about a potential credit card interest rate cap that's been proposed, which is fascinating. We'll talk to that, maybe even a couple other interest rate items that you put on the list there as well. Then we're going to jump into strategies and the mindset for how much Roth IRA or Roth 401k should we have? And obviously that is an open-ended question. We'll provide some rules of thumb, some hard-hitting strategies that may be appropriate. And it's going to be a lot of good stuff. This is one of our podcasts, Andy, that will have some hard-hitting ideas, strategies, and thoughts. And some of them are just kind of how to think about things. But what do you got on that? Anything to add on that?
I think that sounds great. I love jumping into the hard-hitting.
It is.
It'll be good.
Absolutely. The meat of the mission. But here at Pilot Money Guys, our mission is to provide actionable ideas on finance, to simplify the complex and help with a mindset for success. Andy, how does that sound?
I love it.
I just made that up.
That can't be true. That can't be true.
I think it came out so easy because it is true. It's like, that's what we want to do. Simplify things, provide actionable ideas, not advice, by the way. And then just help people. To me, mindset is everything. So I get excited about it. All right. So let's jump in. First of all, Andy, tell me what you know, what you feel like is the most urgent, actionable item for our airline pilots specifically about this Roth.
Yeah, the Roth catch-up is funny because I feel like we've talked a lot about it, but we have to keep talking about it because it's one of those like rule changes that sort of just slid under, but it was pretty impactful in terms of just the execution. Every airline seems to have taken a different approach, and custodian, so Fidelity, Schwab, seems to have taken a different approach in how to implement this. So they've taken a sneaky change and made it kind of complex. But I think the big thing, Charlie, that we've seen for pilots is making sure that if you need to make a positive election, in other words, you have to go on to Schwab or workplace.schwab or net benefits for our Fidelity folks, that you have to go in there and make sure that you're set up so that once you start doing this Roth catch-up, or I should say catch-up, it's going to happen if that's in fact your goal.
Yeah, absolutely. Yeah, I think just to add on to what you said, it's rare that we have to go in to our 401ks at the airlines and make a positive election. And that means most airlines, we believe, as best we can tell, if you don't go in and do something, you may not get any catch-up contributions.
Yeah.
And so I think we can't stress that enough because, like you said, it was a little sneaky. And we're just not used to having to go in and do something but I think it makes sense. And here I'm going to throw my theory at it because think about it this way. If you didn't have to go in and make a positive election, then that means you would get Roth catch-up by rule, by law, IRS regulation, and now your taxes just went up without you positively consenting to that. That's my theory, Andy. I don't know if it's true or not, but it kind of makes sense. You know, if you think about it that way, you got to go in and go, yes, I'm willing to do Roth catch-up, and yes, it will most likely make my taxes go up a little bit.
Yeah. Yeah, or at least stay the same because because previously you were getting that deduction for taxes. And maybe we should just take a step back for our audience and just say, what is the what is the catch-up rule in general?
Good idea.
You know, so if the idea here is if you're 50 and up, you can make an additional contribution into your 401k. So that's $8,000. And then we've got super catch-up, so 60 to 63, which is 11,250 as catch-up contributions. That's in addition to the 24,500. We'll call that the 402G, the normal contribution limit. These are all 2026 numbers.
Absolutely. Yeah, great. And by the way, if you jump into that 11,250, if you're 60, you don't have to do anything different except make sure your contribution rate is high enough. Yeah. And that's going to vary a little bit depending on your income. So we're finding that our captains, in general need to be 11, 12. Some of the unions are saying 13%. That's going to cover even the lower income, lower flying captains and some of the lower income first officers, I believe. So think about it in those ranges, if you will. Yeah. So awesome. Again, you've got to go in your 401k, whether it be Net Fidelity, Net Benefits, Schwab, retirement plan, and make the election. Anything else on that particular rule or rule change, Andy, that we can help people with?
No, I think there's maybe some mindset shifts there in terms of if you were doing Roth already, right? So like last year you're doing Roth and then you were getting tax deferral on the catch-up because you couldn't do Roth as catch-up in 2025 and earlier. Now that catch-up is all Roth, right? So if you were targeting a certain percentage between Roth and pre-tax, you've got to do a little extra math there to get those numbers right when you start taking into account the catch-up component.
That's a great point. For example, previously, let's say your goal is to be 50% Roth, or let me say it this way. Your goal is to be half Roth and half pre-tax. Now that your catch-up has to be Roth, you got to go back and recalculate those percentages to keep that ratio the same. And so that's a little bit of mental gymnastics. You and I have thought about that mental gymnastics a lot, so we can kind of spit it out, relatively quickly. But if you're just now doing that for the first time, it requires a pen to paper at least to do some of that 8th grade math to go, okay, how the heck do I do this and keep the ratio the same, right?
Yeah, and it's definitely 8th grade math, but it's also like, we've tried to create the flow chart and every time we're like, what is happening right now?
And trying to do this online with a client at the same time is mind blowing. It's like math in public. Yeah. It's nearly impossible. So anyway, but give us a call, email, and we will help with that 8th grade math because we've talked about it.
Yeah, it's easy and hard. I don't know how it happened.
It is, yeah. It's weird. So that's important. Okay, I think we've hammered that. Now, I want to back up a second and say, look, you don't have to do this tomorrow. This is not like stop what you're doing and do it right now. You've got some time because, the contributions are ongoing. However, especially at Southwest, I don't want to introduce confusion, but Southwest has a special requirement. You've got to fill up the 24,500 and then your Roth catch-up contribution starts. For most people, that's not until spring, summertime. But if you're massively throwing money in there, you might need to do this in the next couple of weeks, okay? Instead of the next couple of months. All right.
Yes.
Hopefully I didn't confuse there.
Yeah, it's not, I think some folks are thinking it's like an open enrollment type of, like your deferred comp plans or medical plans, like it opens on January 2nd and closes. There's no closing. The closing, to your point, Charlie, is just when you would start making Roth catch-up. You would obviously at that point need to have the settings correctly, set up on your 401k.
Absolutely. Yeah. And we'd love to help with this. I mean, the mechanics, we've seen the mechanics at all the airlines now, where the settings are, how to set the settings up. We've been going through that a lot. Again, reach out to us, info@leadingedgeplanning.com. You can reach out to us directly, Charlie@leadingedgeplanning.com, Andrew@leadingedgeplanning.com. Okay, Andy, I'm going to touch on the Roth NEC option. before we get into the other cockpit questions. The Roth NEC option has been interesting because that's brand new. I'm not even sure that's available at every airline yet. I think it will be. But the Roth, let me back up and set the stage. As you said earlier, at least at one of our airlines, and it's Southwest, I'm not sure if the others are there yet, they will be. You have the option to go in and tell your airline, make all of the NEC Roth. And by the way, it's all or nothing. It's I want all my NEC to be pre-tax, which it is currently, or I want all my NEC to be Roth. And NEC, by the way, is the 18% contribution the airline's making on behalf of the pilot. So, Andy, who should consider this opportunity, I'll call it, to make all of their NEC Roth? What are your first ideas?
Yeah, I think about it. It's going to fall into our Roth conversion discussion, right? Because it really is just a Roth conversion, or at least the way I think about it. So in other words, you're telling the airline, just take that 18% that was going to go pre-tax and just convert it to Roth. So when you think about, should I do this? It's the same question you should ask yourself of, should I be doing Roth conversions, this year? And then I think if the answer is yes, then that's probably the first place to start. It's kind of the easy button for a Roth conversion. And, I think about pilots who this would be maybe appropriate for. If you're on some sort of long-term disability, loss of license, your income is going to be pretty low. If you're retiring this year, if you're if you're retiring in May, is kind of your last opportunity to sock a lot of money into Roth, and your income, of course, is going to be far lower. So yeah, I think those are kind of my first thoughts. But what do you think, Charlie?
Yeah, I'll add on that if you're not doing Roth contributions already, let's say your 401k contributions are pre-tax, then you wouldn't jump to making NEC Roth. I know that may be obvious for most people, but in other words, let's pick the low-hanging fruit first before we get to Roth NEC, which is a pretty big commitment. And I'll go over the numbers in a minute. But before you get to the NEC Roth, which can be a good strategy for some people, you need to have probably checked a few boxes already. One of those boxes is, I'm already doing Roth 401k contributions. And I'm already doing backdoor Roth contributions, maybe.
Yeah.
And so I've checked, those are a couple of low-hanging fruit that you may have already selected. If you can check those boxes, then maybe Roth NEC is a good idea. However, the numbers are big. And let me throw a couple out there. Most of our pilots are either in the 24% marginal or a 32% marginal tax bracket. I'll start with the 24%, Andy. So here's an example. Let's say you are contributing the maximum to your 401k, $24,500 for 2026. And then your airline is 18%. They're going to get $47,500 in the 401k. Those two together equal $72,000. That's the IRS limit. Okay, I've gone through a lot of numbers already. Let me back up. The important number here is the airline NEC could be, in this situation, $47,500. So that's exactly like them just paying you extra money. You just got paid an extra $47,500. You're going to get taxed on that. If you're in the 24% tax bracket, that's an additional $11,500 in taxes that you have to make the election to withhold more additionally because the airline won't do it for you.
Yeah.
Okay. Did I say all that correctly and clearly?
You did. And I'll just say, I've seen this in practice. A client shared a pay stub who was doing Roth NEC, and it's not on the pay stub. And so, and we knew that was going to happen, but I think it's important to emphasize to what you just said, Charlie, which is that's taxable income that's not showing up on the pay stub. I mean, there's no withholding for that income. So you've got to go in and do quarterly estimated tax payments for that tax, tune of, $2,000, a quarter.
Yeah. You got to do something. If you don't do something, you turn the Roth NEC to Roth, you don't do anything. Mistakenly, you think the airline's going to take care of it for you. You're going to have next April 2027, you're going to get the shock of about $11,500 tax bill that you didn't expect. So
plus maybe a penalty if you under withheld.
Good point. Yeah. So think about that. Now, who is this right for? There's a couple people that I can think of off the top of my head that have their young FOs. Maybe they're in their lower income earning years because they just started. They also may have large tax deductions because of other circumstances. Maybe they're charitably inclined, Andy, or maybe they have a farm, that there has some special tax deductions. So that could be a candidate for this. But again, I think it takes some pretty careful thought on this because this is I like it. It's aggressive. You get big time Roth in there, but man, you better be ready to know the numbers.
It's a tool in the tool shed.
Yes.
Is what, when you start, and everyone's situation is going to be different. One thing we didn't talk about was like mega backdoor Roth, right? You can make, United Pilots, I know, can make after tax contributions concurrently. So there's just levers to pull, tools in the tool shed, however you want to say it, to accomplish your particular financial goal. This is just one more tool to talk about. Yeah.
And there's a lot of them at the airlines, which is great. And we're going to talk about that in the second part of our podcast here, because we're going to get into what is the mega backdoor Roth? How do I do, or why might I consider the regular backdoor Roth IRA? So we're going to hang on for that. We're going to go into some of those strategies in the second half of our podcast. But I think those are the things I wanted to cover that were kind of quote unquote urgent, because it's just going on right now at the airlines. Not because you got to make an election tomorrow, but because there's a lot of questions. So we wanted to get that out there first in case you're pressed for time. And now I think, Andy, we can transition to a couple of other questions we're getting questions from the flight deck section. Anything on the Roth catch-up or Roth NEC that we missed out on?
No, I think we covered it.
Right on. Well, the next part here, I'm going to tee you up for this. I didn't even know about this. I'm kind of turned off the news lately.
Yeah.
But I missed this one. Evidently, President Trump has strongly recommended, and you can clarify how this works with a law and recommendations or what ideas from the president about a 10% cap on credit cards. Maybe you're going to touch on 401k loans, mortgage rates, et cetera. But this is pretty fascinating, Andy, especially as it pertains to economic fundamentals, which I think are very interesting in these situations. But what do you think? What's going on?
Yeah, it's an interesting topic, and I think first, as you noted, right, the president said he wants a 10% cap on credit cards. That's probably some sort of legislative action that's required to enact that. Those are probably where that's going to need to happen. But so I don't think it's going to be a snap of the finger, executive order. There would likely be some legal challenges down the road, but I think it's just interesting to think about, and for our listeners, like, does this benefit me? Would this be a good thing? And I'm not so certain, right? Because, when we look at debt, right, and we think about how much debt is good debt, bad debt, like credit card debt's generally not where you want to be, right? It means you're spending more than you're. Yeah.
Understatement of the.
Yeah. It means you're spending more than your income. And so I think that's kind of the first thing is like, and I get why, if you're the president, you're thinking about the midterms, you're thinking about the economy, you want a strong economy. The consumer, in the U.S. economy is about 68% of the U.S. GDP. So in other words, us going out and buying things at the store, going to, restaurants, Lululemon, what have you, right? And going to get our joggers and leggings, Charlie. Yeah. That's a large part of our economy. And so if you want to juice that part of the economy, then make it just like when the Fed lowers interest rates, right? Make it less expensive to do that. Probably still not overall good, I would say, for the economy. The numbers are pretty staggering. Our credit card debt in the U.S., this is as of Q3 25, and this is from the New York Federal Reserve, is $1.2 trillion. Wow. 1.2. Mm-hmm. Our total debt is 18.5 trillion. Now, some of that's mortgage debt, which of course those are not bad things, but that's a big number of debt, just credit card debt. Yeah. And about 7% of that's flowing into delinquencies. So that's the other piece. Like we're already having trouble paying that debt off.
Yeah. This, there's no situation where this is too many negatives, but there's no unintended consequences. Did I say that right? There will be unintended consequences.
Yeah. Okay. Thanks.
Sorry. And we don't really know exactly what those are, but you nailed it. This is just like lowering interest rates. In fact, it reminds me of like low interest rate school loans, right? So if you lower the interest rate on school loans, well, what's everybody going to do? They're going to go get school loans. And then we're going to have huge amounts of school loan debt. So that's something to consider. The other unintended consequence could be that the credit cards go well. We're not going to then offer credit to some people that are higher credit risk. So they just won't get credit at all. And so that could be a difficult unintended consequence. And but this is very interesting. It's interesting how there's laws that the credit card companies will follow, and they will, if there's a law made, then they'll have to follow it. There's no law right now. It would take congressional action, I believe. And so right now, I think Trump's just saying, "Hey, let's do this." But they don't have to do anything until there's a law, and they've not done anything. And so anyway, it's pretty fascinating.
Yeah, no, and I think if you look at what are current interest rates, credit interest rates, the average is about 29%. That's what is what they're currently charging. That's a big number, but you think about this is unsecured debt, right? If you stop paying, the credit card company just loses out on that loan they've effectively given. They have to write that loan off, and so then it's not price gouging. It's just they're taking on risk when they give you credit card debt, and it's more risky than a mortgage, because a mortgage, if you stop paying, they can just take the house and sell the house. They have recourse into that debt, and so I think that's an important consideration. And you're right. If credit cards are capped at 10%, then they're just going to say, well, we're not going to lend to these higher risks. And some of those people, they're going to go get that debt. They're going to get it one way or the other. And it's probably going to be in a more predatory fashion.
Yeah. Payday loans, et cetera.
Yeah. Yeah, exactly.
Which are way higher than 29%.
That's right. Yes. Yep. So that'll be fascinating to watch and see how that plays out in over the next weeks and months.
Yeah. What do you got for us on the mortgage rates? Anything there?
Yeah. So that's it. Kind of, I think, similar vein of trying to, if you're, again, the president wanting a strong economy as we head into the 2026 midterms, housing affordability has always is kind of front and center. And so part of that is the president directed, hey, go out and buy $200 billion of mortgage-backed securities. He directed some agencies to do that. So functionally what's happening when an agent, those are the government sponsored entities go out and buy these loans. Well, that lowers the rates on mortgage-backed securities, which means banks are going to issue mortgages at a lower rate. So, and that makes the houses more affordable, right? I think that's fairly intuitive. I think it's, when you look at what are the components of a 30-year fixed? They're probably at about 6.1%. Some of that's just the 10-year Treasury yield. So the 10-year Treasury note, what is that yield? What's inflation? The Fed fund rate. So there's the point is there are lots of things that make up a mortgage rate. And, we're at 6.1%. That's probably historically in line, maybe a little lower. 1982 to 2006, the average rate was 8.9%. So I think if we think we're going to get into the 2.25s, right? We see clients all the time. We're like, my mortgage rate's 2.25. It's like, dude, you'll never see that ever again. Yeah. And it was people who were getting it, but they could get a 30-year fixed at 2.25, and they were like, but I want the 15-1 arm at 2. Okay.
That's amazing. Yeah, it was definitely one in a lifetime scenario for sure. And
it's significant. I mean, it is a big driver of rates, but at the end of the day, there's lots of factors that are influencing mortgage rates. So it remains to be seen.
And it's hard to get away from just the basic economics and a free market economy, and that's just supply and demand. And that's a good thing, what did Adam Smith call it? The invisible hand effect, of just the supply and demand in a free market economy, and that tends to benefit us as a whole. So anytime you mess and try to artificially constrain things, there'll be unintended consequences, which are interesting. So
I think the Wall Street Journal had a great article maybe yesterday. It was there's someone has to lose for houses to get more affordable. The person's selling it has to sell it for a lower price then, or you increase the supply. but there's someone has to not benefit from that.
Yeah, absolutely. Nothing is ever as easy as we hope it could be, right? Do
Yes.
this and this will happen. And
Yes.
never the case especially in economics and finance. But
I
Andy, any other questions from the flight deck that you're thinking about that you've come across?
think those are the big ones.
All right.
Did I miss any?
No, I don't think so. I mean, it's fascinating, especially this just to see what happens with the credit cards and things like that. But it's probably nothing
Yeah.
that happen really soon unless they just voluntarily, do stuff.
Yeah. It's fun to talk about.
Yeah, absolutely. So now we're going to get into the meat of the mission, and that is why, how, when, how much Roth should we consider? I mean, to me, Andy, and I know in our interactions with all of our clients and everyone out there, it's probably the biggest question on savings. It's like, how much should I have in Roth? How much should I have pre-tax? And just let me set the stage for a second, because taxes is a very emotional issue, and it really, quite frankly, pisses a lot of people off. We get it, right? We understand that.
Yeah.
But it often drives us into strategies that are maybe counterproductive in the long term. And again, this is understandable. I'm not criticizing, and we feel the same way. So our natural inclination then is to like, well, I'm going to defer everything I can, save taxes, everything I can right now, which sometimes is the right thing to do, but we got to be careful. We got to be careful to optimize this decision, in other words, to balance this decision. Because like you and I've talked about with many people, you don't want to show up to retirement and have a worse problem than you have right now. And some people call it a tax bomb waiting for you. You know what I mean? And we've seen the result of that with people in their lives go, I have no options right now. And this is very frustrating. Yeah. So what do you think, Andy? Just kind of setting the stage on this problem.
Yeah, and I think what you mean by that is if you show up to retirement and all you have is a pre-tax 401k IRA, every dollar coming out is taxed as ordinary income. And we'll talk about what are the ramifications, not just on taxes, but Medicare, Social Security, all of those things.
There's tons. That's amazing.
Yeah. And it hurts when if you need X number of dollars, you're like, well, we actually have to pull this much out to pay the taxes, which means more taxes, right? And it keeps snowballing.
It is. It's frustrating. So let me read this. One of our super nerd financial heroes is Michael Kitces. He just provides a lot of great research, a lot of great insight to us as advisors to pass on to our clients. And so I looked at some of the articles he had written on this topic, and he talked about optimizing this decision. He said, understand that there really is such a thing as being too good at tax deferral, but that the solution isn't necessarily to go all tax-free, for example, with all Roth accounts and Roth conversions, instead, which just subjects income to higher tax rates immediately. Instead, the ideal goal is to balance current and future tax rates, finding the optimum equilibrium point that allows retirees to avoid higher tax rates in the future without unnecessarily increasing their tax costs today. So that's a statement from Kitces, which is, boy, that'd be nice to find that perfect balance, but it's so different for everyone. You know what I mean?
Yeah, and a little bit, some of that is like trying to predict what the market's gonna do, right? Like we don't know the perfect balance because we don't know tax rates in the future. So there's an unknown element associated with this. But I think that's a great quote from Kitces. Again, he's a hero. We love listening to him. But it's like I always I say flippantly, it's like when I enter in retirement, I would rather how much Roth? Like all of it. I would want all of it in Roth, except for all these reasons we're about to talk about, where it may not make sense to have all of it in Roth, and it may not be optimal. But to be in retirement and never pay taxes, well, that doesn't sound too bad. Yeah. I can get behind that.
I know. And you brought up something earlier I want to add some color to as far as this idea of flexibility in retirement. So we have, in my mind, I'm thinking of client A and I'm thinking of client B. Client A they came to retirement with some Roth, pre-tax, of course, some taxable brokerage money, which comes out of capital gains taxes, which are in general lower right now, 15%, possibly. Client B came to retirement with nothing but pre-tax monies because they deferred everything, okay? Then client A and B want to build their dream home in retirement. It's time, we're retired, we're going to build our dream home. Guess which client pays a whole lot less taxes right now on the dream home build That's client A, because we get to diversify. We get to pull from capital gains. We get to pull from maybe some Roth monies and of course some pre-tax. We have to manage some tax brackets. Client
Yeah.
B is extremely angry because now every time they pull money out, they're paying, the government's winning at about 35 to 37% of their money going to the government to build their dream home. And that makes people very angry. So that's one example that not mathematical. I didn't mention current tax brackets at all, but man,
Yeah.
that's a tough one. So that's kind of what I think about. But
Absolutely.
lots of other things we'll talk to, RMDs, things like that. But let's jump into, some of the strategies.
Yeah.
So, and why we might want to do this. And so first thing we talked about is, do we pay taxes at our current rate now? Prepay the taxes, in other words? Do we think they're going to be higher in the future? So Andy, talk to me about how I think about current tax rates. How are they relatively speaking to historical tax rates? Are they bad, good? Should I consider prepaying? And how does our nation's debt, all these things about inflation factor in possibly to my desire to have more Roth as well?
Yeah, I think about like a stoplight analogy here, like green, yellow, and red. So if I'm making a decision on Roth, I'm going to think green light is if my tax bracket today is lower than it's going to be in the future, then I would want to do Roth. That's an easy math right there, right? Because, if I'm in the 24 today, I think I'm going to be in the 32 in the future, then like you should do Roth, right? Because that's helpful. And then, so to me, that's like green light, let's go. Yellow would be like if they're the same, right? 24, 24. And I'm like, the math is truly like you should be like indifferent, right? Like it's the same dollars at the end of the journey out on an after-tax basis. In other words, if you do Roth, when you pay the tax today, it grows at, say, some percent, called 8%. You pull it out tax-free. You have the same number of dollars as if you took a tax deduction at 24%, grew it, and then pulled it out and paid the taxes on it. Same number of dollars. So you're sort of indifferent, except for some of these other things we talked about, right? I don't know what tax rates are going to be. So Charlie, we've talked about
we don't know that.
We don't know that, right? And so we're historically low. We could talk about where tax rates have been in the past, but the tax rates can change, right? So you may be in this. I'm in the same tax rate today as it will be 20 years down the road, except maybe you won't. Maybe tax rates go up, right? And so then now you're in the green light. The widow's penalty, right? And we talked about that, Charlie. That's the idea that when you're married filing joint, the income, right? So if 24% married filing joint is $211,000 to $403,000. So you can have $211,000 to $403,000 and you'll be in the 24% tax bracket. Well, if you're single, that goes down to $105,000 to $201,000. So in other words, if one of the spouses passes away, which, is likely to happen at different times, that tax bracket, you immediately go into a higher tax bracket. Not immediately, but you effectively go into a higher tax bracket in future years. And so you gotta kind of plan for that, right? Plan for that other, the spouse passing. Yeah. So that's yellow. And then, I'd say a red light is if you're in a higher tax bracket today than in the future, right? If you're in the 32, 35, you think you're going to be in the 24 in the future. That's like the red light. Like you're probably going to have less dollars, except maybe not, right? There's some reasons to still do it.
I love it. I love that red, yellow, green. Green, we can just mark off the list of this podcast to talk about because you just do it. Do Roth.
Yeah.
It kind of makes mathematical sense. And so that's
right.
Easy breezy.
Yeah. And maybe it's we're talking about like when are you likely to be in the green?
There you go.
Right. Like you're young, young FO, or you're 65, you retired, you have 10 years until your required minimum distributions, your income is going to go way down. You're in the green zone, I think.
Yeah.
Those are like absolutely. The ideal Roth.
Absolutely. Yeah, that's a great way to put it. I love this. And I think our pilots understand because they live it. This is really a risk management decision. There's a lot of variables here. And let's just say, I'm going to throw this out there. Let's say we get the math a little wrong. Like you said, we're in the yellow. We don't know future tax rates. Let's say we show up to retirement, Andy, and we go, oh, I got this huge pile of tax-free money. Man, maybe I should have taken a tax deduction 20 years ago. Nobody says that. If you got a big pile, if you got a big pile of tax-free money, you are jumping for joy. You're not going to have any regret about the math. Maybe we got it wrong. You know what I mean? Now, clearly, we want to try to get it right. I'm not saying just caution to the wind, but I'm saying there's people in retirement, and we've seen this. They've got Roth. They were happy because it eliminates uncertainty, it eliminates tax risk. Again, we don't do it at any and all costs. Just think red light, but nonetheless, there's a huge emotional benefit here that we've talked to a little bit already.
Yeah. Yeah. And to throw some numbers out there, 1987, great year. Was born there. Yeah. What's that?
Were you born that year?
That's right. Yeah. If you were made over $90,000 married filing joint, you were in the 38.5% tax bracket. 90,000. Of course, you would have to index that for inflation, but those are still far lower than what we've seen.
Yeah. Yeah, absolutely. So it seems like the last 15, 20 years, maybe 30. What are you, 30? You're 37. So last 37 years, the tax bracket, the marginal tax bracket has probably been mid to upper 30s. Is that safe to say in that range?
Yeah, I think so. I mean, you can even look at the highest marginal. We were in the 70% highest marginal tax bracket in the late 70s, early 80s, 7%. Now, of course, that's the highest marginal, but those brackets there's a lot going on in those tax brackets. It would not be inconceivable, right? If you look at this kind of the state of our federal deficit, that we've got to figure that out somehow. And one of those ways is tax revenue.
Yeah, that's a scary thought to go back to that rate. But you're right. Who knows? I mean, we can't predict that for sure and don't know what's going to happen there. One more thing that I'll kind of think about here as far as mindset, and then we'll wrap up part one and we'll continue with part two on the not exact, there's no exactness here, but we'll talk about some strategies, backdoor Roth, mega backdoor Roth, now the impacts of the Roth catch-up. But one of the things I see a lot of times, Andy, is when we're in this yellow light caution area where we're weighing the pros and cons, we're doing our risk management, like, should we do this or should we not? Let's just say you're going to pay a little bit more taxes right now, but here's often what that decision looks like. If I'm, let's say I'm a young captain, let's say I'm going to do, maybe I've decided, hey, I'm going to hedge my bets. I'm going to do half Roth and half pre-tax in my 401k because I don't know future tax rates. I don't know. I'm in maybe marginal 24% tax bracket. And so I'm going to try to hedge that bet a little bit. So what that often looks like, Andy, is let's say that I make that selection and therefore about 12,250, I think is the number, becomes now taxable income. And so what that looks like in reality, I can't do the math fast enough, 12,250.
It's impossible.
Sounds 0.24. Yeah, here we go. That's about $3,000 extra in taxes that I'm going to pay. However, here's the point that's important. It's not like you're going to show up in April and go, your CPA, your tax professional, or TurboTax is going to go, boom, you owe $3,000 in tax, write the IRS a check. That's not the way it works, which is kind of good. Yeah. The way it works is your airline is going to take that tax out over each paycheck. They're just going to withhold more. So if you're paid twice a month in the airlines, the payroll department would withhold about $123 per paycheck in taxes. And so that would be the way that you'd pay that tax bill. So now the last thing I'll say on that, Andy, is I've joked with our pilots before when they go, I'm not doing that. I'm not paying more taxes. And I go, I understand. It feels weird to pay more taxes when we don't have to. But my next question is, how much money do you spend on beer? And oftentimes it's more than that. So anyway, I'm joking, being facetious a little bit because it kind of boils down to a cash flow. Now, do I want to have a forced savings right now where I'm going to spend $123 extra each paycheck to invest in this Roth, half of my 401k being Roth? It's like forced savings. I would say that most of our pilots go, I don't think I'll notice that because my paycheck fluctuates so much anyway. So that's just a mental way to think of it. We still got to make the right math decision, but we don't know it sometimes. So I don't know, Andy, am I being manipulative or what? What do you think?
Well, you're very transparent if you are. So that's always good.
Absolutely.
Yeah, you're right. I think that's a little bit of mental accounting, but I think that's helpful when it comes to saving and investing. It's like the same thing we talk about deferred comp plans. Those are just forced savings, tax efficient forced savings. Like you could achieve that same outcome with your spill cash in a taxable brokerage type account. So those are all valid points to make.
Absolutely. Andy, we're going to wrap up part one here, but next time we're going to talk.
We're just getting going.
I know we are. We're just getting going, man. My coffee's just now kicking in. But
That's right.
but we're coming up on our time. So next time we're going to continue this discussion. We're going to talk about how can you take advantage of the mega backdoor Roth IRA, which most of the airlines have, which is phenomenal. We'll talk about how to do that. We'll talk about how anyone, regardless of income, can contribute to their after-tax IRA, and then who might consider converting that to Roth i.e. the backdoor Roth IRA. So there's some gotchas there we need to think about. We're going to talk about IRMA, which means your Medicare premiums in retirement and the impact of Roth on those. You talked about, the widow's penalty a little bit. That's huge. Social Security taxation can be impacted. We're going to do some examples of maybe some lower income folks and their opportunities versus our high income folks that get that red light. What should they do? Yeah. So even more to talk about. Market-based cash balance plan coming online. How can that help? Especially our Delta American. They've already got it going up and running. And so we'll talk to that more. But anything as we end part one, anything you can think about on the mindset or things to come, Andy, on the next show?
I think that's it. When you think Roth the Roth conversion, we talk strategy into strategic into tactical. And that's where you start looking at, okay, like it makes sense to do this conversion, but now we look at senior deduction, IRMA, so all those things you just listed. So this is part one is strategic. Part two is tactical execution.
I like it. So thanks, Andy, for your time today. Thanks all of our pilot listeners. Please share the episode with anyone you think can benefit, especially those that are 50 and over right now, because they need to know that they have to go in and make an election. Otherwise, they're going to miss out on contributing more to their 401k. Maybe they don't want to contribute more now that's Roth, but that's up to them. At least get the word out. Give us a rating and review. We appreciate your feedback there. As I said before, feel free to contact me or Andy. We respond to everything. This will also be on YouTube, so check it out. I don't think we shared a whole lot today, visuals, but nonetheless, if you'd rather
see our faces.
That's right. Yeah, you can see Andy's face. That's always helpful too. So,
see how many times I wear the same shirt.
That's right. It's like a uniform.
Yeah.
Typical prior military. We don't have a whole lot of fashion.
That's it. Yeah, I've got 2 collar shirts in the closet, man. Like what do you want?
All right. I love it. All the best. Stay disciplined. Fly safe. We'll talk to you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.